everyone. My name is Jim Butler. I'm a hotel lawyer. I am delighted today to welcome you to my first Meet the Money online. I had hoped on May 5th to be welcoming you to Los Angeles for 2 days of great presentations, and that wasn't to be with the COVID-19 situation. But we are fortunate today to have 4 of our top presenters giving you the latest information. I think some of it has literally been compiled this morning to show you what's happening in the hotel industry today. I know we have people from around the world, so I see London, Montenegro, Singapore, Hong Kong, Los Angeles, New York. Welcome everyone. There are more than 1,000 people who have registered for this, and it's really an honor and a tribute to the 4 presenters we have here. I think it shows both their leadership and how valuable the information is that they're going to be presenting today. So let me take just a moment. I told you my name is Jim Butler. I'm a hotel lawyer, and I'd like to show you where you're going to be able to get some valuable information later on today. Write down hotellawyer.com. You see, that'll take you to our hotel website, hotellawyer.com. This is where you can get the blog. And over here under Resource Center is where you'll be able to find the recording for today's session and the presentations that are being made by each of our presenters today. It'll be under Hotel Industry Presentations. The recording will take it may take 24 hours. The presentations will probably be up later this afternoon. So with that, we've got a lot to get going. I'm going to start off by introducing Vail Ross of STR. And Vail, tell us what's happening in the hotel industry today. Give us the information.
Thank you, Jim, and good morning, good afternoon, and good evening to all of you. My name is Vail Ross, and I am the Senior Vice President of Global Business Development and Marketing for STR. For those of you who may not be familiar with STR, STR provides clients from multiple market sectors with premium global benchmarking data for the hospitality space, along with analytics, consulting, and market insights. So I'm going to take a moment here and share my screen. I'm going to share with you a lot of data of what we're seeing here in the US, as well as share a little bit of what we're seeing in China and Europe, but my main focus will be on the United States. I am going to focus on weekly data just because it is an ever-changing environment in which we're in. I do want to mention before we get started that STR is keeping a COVID landing page like many of the industry partners around the world. We want to make sure that all of the stakeholders are kept up to date on the ever-changing environment. So if you go to str.com, there's a COVID update link that will take you to all of the recordings that our colleagues do around the world on a weekly basis, keeping everyone up to date of how the data is changing and trends that we are seeing as certain cities and countries around the world are opening. So with that, let's just briefly talk about what we saw in April. STR for 16 years. STR has been in business for over 30 years, close to 35 years now, and this is absolutely the worst month of performance that we have ever seen in our benchmarking. These numbers are quite staggering, and when you look at them, they're oftentimes just very difficult to absorb. So for the month of April, we saw room supply down over 12%. We are having closures left and right with the hoteliers, oftentimes temporary, in some cases not necessarily up to their discretion, but to the jurisdictions in which they lie. So we are tracking those closures on a daily basis. Room demand was down over 68%. Occupancy for the total US for the month was 24.5%. Obviously, that is having a dramatic pull on the overall RevPAR, which was down almost 80% for the month. Interestingly enough, we started our year quite strong. So January and February were not that bad for the US lodging industry. But when March and April came along, it took a turn for the worst. And we could see that impact here in looking at the key performance data for a 12-month moving average. Supply is still slightly positive at 0.8%, and demand down about 8%. And you can see the performance there with an overall RevPAR almost down 10%. This is one of those slides historically we have shown in looking at the long-term average of RevPAR growth, and it just really puts in perspective the downturn in which we're in. And, I have this comment here, tongue-in-cheek, that this one is going to hurt, but it is going to hurt, and it is going to take several years to recover, longer than what we have seen in prior downturns due to the severity of the COVID impact. So let's quickly go into weekly data, because what we are seeing is that April appeared to be the worst of it. And as we move into May, we're starting to see some glimmers of a little bit of hope. So if we look at RevPAR declines on a week ending May 16th, so this data was just processed and released last night and early this morning, we saw for the total US for the week ending, we saw RevPAR declines around a little more than 73%, which is less bad than what we saw a week before. In looking at across the class performance, we can see that if we compare to where we are today to where we were on April 11th, we are at least moving in the right direction, and it is less terrible than what we've seen in prior weeks. Obviously, the impact is really being felt strongly on that luxury through upscale class, those full service properties, not only with the loss of group business, but obviously the majority of these properties have a majority of their supply in the top 25 markets, which have been hit tremendously with this pandemic. The numbers are moving up, but however, they are feeling the most pain in those sectors. The one class that is not feeling as badly is the economy class. It has not been hit as hard as some of the others. Interestingly enough, it did have a worse week than it did the week before last. However, we do foresee that as we move into the rest of May, that trend line will change. And looking at some location types, as we move through May, what we are seeing is that the interstate and really the small metro towns are feeling a little bit less pain, and it's really no surprise. We're still moving transport. People are still moving around, whether they are for frontline workers or whether they are still in the construction space. There are still truckers out there, Amazon trucks are out there, and people need a place to stay. So the interstate location type hotels and the small towns are not feeling as bad as some of the other ones, such as the urban market and the airport market. So as we've been collecting this daily data for all of our hotels around the world, and as we've seen certain states and regions starting to open up, we've been diving even deeper and looking at some comparisons of weekday versus weekend performance. For the total US, the weekend performance for May was almost at 35% occupancy. Some of this is coming off of the week before and building into what we saw ending on Mother's Day weekend, having that impact. But these beaches are starting to open here in the United States, and we are seeing that if you are a drive-to destination, there is a distinct difference in your performance from weekday versus weekend. Here are some of the top submarkets within the United States. Again, week ending in May, where we were seeing occupancies on the weekend at almost 75% in Myrtle Beach, Daytona Beach, Fort Walton. Those numbers will likely change a little bit as we've heard that the governor of Florida is starting to limit the beach hours, and as we move into Memorial Day, that may change. So it'll be interesting to see how that impact may have on the surrounding states in Alabama, where they're not necessarily making any changes to their beach hours. But right now, the drive-to markets seem to be doing quite well as they're starting to open, as well as these southern states have now lessened their stay-home restrictions. In looking at the top 25 markets at the week ending May 16th and sheer occupancy, we can see that 13 of the top 25 markets are experiencing occupancies between 20 to 30%. This is actually 3 markets better than what we saw last week. If we had the time to dive deep into each market of what's driving that demand, that's driving occupancy, it would be quite different. In Norfolk, Virginia, we have a Navy base that is really impacting that. New York, we've had a lot of impact with frontline workers and our first responders. And then in other areas such as Florida and Tampa, it's been a little bit more of the lessening of the restrictions. So each destination has its unique story of what's driving the performance. One thing that we have been tracking and been keeping an eye on is just overall TSA checkpoints and how it relates to room demand. And we started this back in March 7th. And what we have seen is that obviously people are starting to get a little bit closer to getting on airplanes. Again, the type of demand that is having to travel is impacting this, but continuing to watch this ratio and this relationship between rooms sold as well as the TSA checkpoint count data. So just briefly, in the next couple of minutes, I want to just see and compare what we're seeing with China to the US as well into Europe. As we all know, China was hit by this pandemic a lot earlier on, and you can see that here, what that had with the impact starting February 1st to their occupancies, where it was down 10%. They are moving upwards, and a lot of this recovery is coming from more leisure and weekend recovery there in China, mainly driven by that domestic. Some resort and state parks, or excuse me, national parks are opening up, and they are then seeing some uptick there. There's a great video on the STR COVID page from our colleague that runs our Asia office that was released on Monday. I highly recommend you listen to that recording, and it has a lot of great insights of what's going on in China, as well as what's going on with Europe. It really has flatlined. We've not seen that occupancy start to swing upwards like we have in the United States. There are still several areas that are closed, and we're continuing to see that impact on occupancy. So to see of what we have in the future, one of the things that we've looked at when this all happened, obviously we wanted to look and see in past downturns, what did we learn and how can this apply to the environment in which we're in today. And there really is no comparison to any other downturn. But one thing that I do want to call out that will have some insights to when we get into our forecast, particularly around ADR, is one thing that we have learned in past downturns is that we never see a V-shaped recovery as it relates to ADR. It on average will take twice as long from when it took to drop as it will to recover. And as we know, we've seen ADR declines way more extensively this time around than in the past 2 downturns. So yet again, we do not necessarily predict that a ADR rebound will look as a V shape, but it will probably be a much longer U. And depending on if we have continued outbreaks, it could look more like a W as we move on. So with this said, just to wrap up here, I wanted to share STR and tourism economics forecast for 2020 and 2021. There's one thing that you will notice that is different from the STR forecast in the past, is that we are putting in an economic supply. And what does that mean? Economic supply methodology is assuming that there were no temporary hotel closures. So we are not taking that into consideration. We are forecasting as if every hotel in the United States was open for business. And the reason why we did that is we heard from our hotel owners and operators that that is what they are doing. They want to assume the bottom base and where do we have to go from that bottom baseline. So we are obviously reporting out on our occupancy and RevPAR utilizing this economic supply data. We are forecasting that demand will be down 45% this year, up almost 50% in 21. Obviously, RevPAR down over 57% and RevPAR up at 48% in 2021. Now, while those numbers seem quite high, do keep in mind when we look at the actuals, it is not to where we were. We're not getting back to where we were in 2019. It is our forecast that we likely will not get back to 2019 numbers until 2024 and potentially 2025. So to wrap up on my 12 minutes, and I went a little over, there are some 5 key takeaways here that I wanted to cover with you, and you'll have them with you, but there are really going to be 3 main drivers to this recovery, and it will have a lot to do with group demand, drive markets, and the corporate business side of things. So if we have some time at the end, I'd be happy to answer any questions. And with that, thank you for your attention, and I'll turn it back over to you.
Thank you, Vale. I guess we have a lot less terrible to look forward to. Jamie Lane, we're looking forward to hearing what you have to say about the whole economic picture and how hospitality fits into that. What can you tell us?
Thanks, Jim. And assuming you can see my screen okay now?
We've got it. Thank you.
Great. So I'm Senior Director of CBRE Econometric Advisors and Head of Hotel Research now for CBRE Hotels. I manage our team of economists that forecast all sectors of real estate, and I focus specifically on the hotel sector. CBRE, as many of you know, is the world's largest real estate company and provides services for all aspects of the hotel industry, including brokerage, valuation, advisory, debt and structured financing services. My research team provides forecasts for the top 60 lodging markets and P&L benchmarking data. Just so you have it, today's presentation is available on our website under presentations. So the lodging sector has been hit by 2 headwinds in 2020, a contraction in overall economic activity and the need for social distancing. I'm going to get into the economic side, but first I want to focus on what's happening in the pandemic and how it plays into the lodging recovery. This chart shows the 7-day moving average of daily new COVID-19 cases. Most countries are well past their peak and well on their way to opening back up their economies if they haven't already started. The 2 that are worrying are the US and UK, which seem to be slow off the mark in controlling the virus, which have picked up a little bit of steam in recent weeks. New York has brought their cases down significantly when broken out from the US. This next slide, though, shows the data slightly differently, and it shows the same 7-day moving averages of cases, but then aligns their peak, indexes them to their peak, and aligns them to the same point in time. This allows us to control for the size and more easily see how each country has bent its curve downward, and then plot when they start back up, opening back up to dining and hospitality pursuits. Italy and Germany have made commendable progress in reducing their new cases. They've opened up restaurants over the past week. And Italy announced that it's opening its borders to travel starting in June. Most European countries, though, have had much more stringent lockdowns than those in the US. And hotels that are open in Europe are still operating at occupancy levels at or well below 10%, much lower than those in the US, UK, and China, as Bill showed. Our assumptions are that the US will begin any significant travel after about 8 to 12 weeks after its peak, or probably around mid-June. Well, it's going to vary by state, we're already seeing some states start to reopen, as Vale showed us, that can support drive-to leisure demand, and they are showing signs of recovery. We still see some time out before seeing a return of corporate, group, or inbound international travel, which is definitely or probably be dependent on widespread availability of vaccine or treatment to return to pre-COVID levels. This chart also speaks to the fear that will no doubt be a component as countries and states begin to reopen. And in Atlanta, our restaurants are open to dine-in seating. They opened earlier this month. The open table restaurant data shows traffic still down 90%. And we still haven't seen a meaningful decline in the number of new cases. While in Germany, where the cases are down significantly, reopened restaurants last week and traffic's down only 60% and growing strongly day to day. So while there may be political and economic will to reopen, fear is going to be a powerful emotion in this recovery, and it's expected to reduce demand in hospitality-related activities for some time in the future as we get the virus under control. And given the uncertain path, and there's much more uncertainty today than in prior forecasts I think we've ever done. And I would suggest everyone get comfortable with both the impact of our wide range of scenarios and what that means for their properties. So in thinking about how we forecast today, I was going back through some of our stuff from early in the days of forecasting to give some guidance on what we might see in the future. We build models that relate to economic up and downs of hotel performance. When major events happen, we turn to them, and when they've happened in the past, and use them for forecasting the future. Our group did our first ever lodging forecast on September 8th, 2001, 3 days before the tragic 9/11 terrorist attacks, and just 1 month later, got our first published forecast out to subscribers. In that letter that accompanied those forecasts, we talked about the stigma effect on air travel and the negative impact over and above the economic impact and how it would vary by sectors. But it's important to note, by April 2002, just 7 months later, demand had already returned to pre-9/11 levels, with strong gains in interstate and small town hotels. Pent-up demand, though, only lasted a few months before the ensuing recession and SARS pushed demand back negative and delayed the overall rate recovery, which Vail outlined. The US hasn't been here before, but we have enough confidence in prior tragedies that this too will bounce back. And using Asia's example for today's COVID pandemic, the economic activity recovery will be faster than that of the great financial crisis and 9/11 periods. So let's turn to the economy real quick. Q2 figures for just about any measure of the economy are going to be brutal. I suspect Q2 numbers for GDP will be about negative 36% annualized GDP and close to 20% unemployed. The true test for the forecast, though, are going to be the rebound in Q3, which we have penciled in at about 26 plus 29% annualized GDP growth. So where does this growth come from? First, spending activities that accompany sort of reopening, and restaurants, leisure, hospitality type industries, and the urge to get back to normal life from consumers. As the recovery gets going, it's gonna be supported by unprecedented levels of government support, fiscal, monetary policy, and some that we haven't even seen enacted yet. For the time being, though, we're in the uncomfortable position of waiting for this to happen. The recovery in China, which is a model for how we'll be going forward, is proceeding as expected. Asian countries are getting back to life more broadly, and also history tells us that economies bounce back quickly. The hard evidence, though, is thin right now. Are there risks? Absolutely. And there's the second wave that could come in the autumn, which necessitates further lockdown. Will there be financial aftershocks and a potential retreat from globalization? And we haven't even spoken to the upcoming election. But for now, for the economy, we do think it is more V-shaped, where for hotels, it's going to be more like a Nike swoosh. So a quick pullback and then a prolonged recovery. We are, as I said, forecasting a variety of scenarios, both economically and for the hospitality industry. Our current baseline calls for a 2-year recovery in employment, where our downside and severe downside push that out to 3 or 4 years. Turning to the hospitality side, though, and there are no areas that have been spared from the pandemic. Our new forecasts released this week show a 50% decline in RevPAR this year, and that occupancies will average just 41%, well south of last year's record of 66%. And that there is an expected quick rebound in economic growth, as I said, supported by the resiliency of travel. We expect that demand and should recover by the back end of 2022, and that RevPAR will be back to pre-recession levels by the backside of 2023. We're using two main sets of assumptions this time around. First is our traditional model, which applies the relationship of economic activity to the lodging industry. This is our traditional one, and it calls for the 2-year recovery in demand. ADRs will take another year on average, much longer in some markets, and domestic travel will make up most of this year's demand, which means lower ADRs. We expect supply growth to halt after an initial wave of deliveries this year. But for 2021, as temporary closures become permanent in some cases, and some hotels convert to other uses like apartments or condos, we're expecting supply to go negative. The industry will also benefit from fewer short-term rentals in many of the major cities, though there could be a further race to the bottom as short-term rental operators compete with hotels for limited demand. The second set of assumptions are, and specifically around restrictions to travel, which are new inputs to our forecast models. Today, roughly 18% of US hotels are closed, with over 50% of full properties having their doors closed, with many struggling to cover fixed costs. We expect travel to gradually reopen starting in June, but that occupancies will remain below 50% through mid-2021. Assuming a treatment or vaccine starting next year, we expect to return to more corporate, inbound international, and group travel heading into 2022. So what does that mean for the chain scales? Recovery timing is going to vary by market. And consistent with prior recessions, the severe declines in demand are going to have a negative influence on pricing. Discounting is not the major factor, though, that's impacting rates right now. It's, in my opinion, and our research shows that it's more the shift from higher price accommodation hotels to the lower price. So, for example, the top 3 chain scales represent 44% of the lodging supply. However, upper price properties will accommodate 52% of the incremental demand re-entering the market in 2021, with most of the new demand paying the higher room rates, which will skew the ADR growth upwards, which I think is the major difference right now between our forecasts and STRs, is we're calling for higher ADR growth. It definitely doesn't have anything to do with, and we see a return to pricing. It's more of the business mix that will be playing out in the recovery in 2021. So as some states start to recover, we are seeing green shoots. As Vail mentioned, many submarkets and coastal drive-to destinations have seen significant increases in demand, with weekend occupancies in some over 50% or up to 70% this past week, which supports our thesis for leisure drive-to markets recovering first. And this shows in daily traffic. We're seeing definite peaks on the weekends, and definitely seeing pre-bookings for hotels accelerating pretty sharply heading into the Memorial Day holiday. This chart shows our 3-year nominal recovery for our current baseline and how it compares to other past cycles. We are in line with the recovery timing right now with 9/11, the 9/11 recession, slightly less than that of the Great Financial Crisis. Our downside our downside scenario pushes that recovery out to 5 years, and that's what we're suggesting people look at right now. It's our baseline and downside. We're putting roughly 40% probability on each of those, with definite and risk to the downside. The impact will vary by each market significantly, This shows 2020 forecasts for the 60 markets that we forecast, with the most impacted markets, New York, Seattle, Boston, DC. They'll see the deepest RevPAR declines. And I want to leave you just on the last slide. It mimics some of the first slides that we were seeing in the new cases, COVID-19 cases in some states of interest that are beginning to reopen, like Georgia, Texas, Florida. They're opening up to more commerce. And I'm hoping that we can continue the overall reduction in number of new cases. And I suspect that hotel occupancy, like the sustained restaurant demand, will be linked to that drop. So fear is the number one factor here impacting near-term performance. Once we're able to reduce these number of cases, I suspect, and the pent-up demand will come roaring back, and we'll be well on our way for recovery heading back into 2021. With that, I'll pass the baton on to Suzanne, I think.
Thank you, Jamie. I appreciate it. I like the quick V bounce back initially, but the 5-year recovery looks like a long, painful, slow slog. So with that, let's move to our next presenter, Suzanne Mellon. Suzanne always does one of my favorite presentations on cap rates and valuation. Suzanne, take it away.
Great. Can you hear me okay?
Yes.
Great. Thank you. Thank you so much for holding this, Jim. Really appreciate it. And thank you, Vail and Jamie, for laying the foundation to the topic of my talk today, hotel values and cap rates, which historically has not been that difficult a topic to talk about. But right now it is one of the more challenging, given all the uncertainty that and what you've been hearing about today already. So I just want to, here we are in an unparalleled downturn, as everybody knows. I just want to speak a little bit. There are a lot of people out there say, you know, how can anybody value anything now? Nobody knows. There's no way. Anybody who tells you that you can value something is, you know, they're just lying or they're making it up. And I just want to say that's just not true. There are people who are valuing assets every day now. There are people who are gathering capital to decide what to buy. There are sellers who are determining what their assets worth. We are modeling. Many people are modeling and trying to figure it out. I would totally agree. It's very uncertain. And no doubt whatever we forecast will probably end up being different than we are, what we're estimating and what our opinions are at this time. But it's no different than economists forecasting and all of us just trying to figure out what the future may hold for us. So I just wanted to lay that foundation out there that we do the best that we can based on the available information, and just like everyone else. So that's the premise for today's conversation. You know, as we look at values, and I just want to start my timer here actually, so I can make sure I don't have this on here, so I don't go over time, because I'm kind of known for that, right, Jim? Hang on here. Start. There we go. The sales volume and the pressure of transaction activity is always an important thing to keep track of. And this shows a trend since 2006 of transaction volume by Real Capital Analytics. And you can see we've been in a fairly healthy transaction market. Gosh, since 2014, 2015 was the peak. The individual asset sales have held up, and the peaks and valleys have really been more impacted by whether there's a portfolio or entity transactions. But if you look over to the right, you can see a tremendous decline. Transaction activity had already dropped by half just for the first quarter, and that's before we started into the impact of COVID. So the market had started to slow already. And here we can see the transaction volume by portfolio, entity, and individual sales transactions. And you can see also to the right, individual sales transactions has already dropped in the first quarter from 7 billion to 3 billion. Tremendous decline, already indicating that there was uncertainty in the market. We had been talking about values flattening and what was going on. Well, actually, nobody was addressing values, but we had been hearing about slowing or declining RevPAR, increasing operating expenses over the last couple of years. And of course, that translates into slowing or moderating value trends, and we had already started to see that. Another thing that contributes to values, which is always important, is the cost of capital. And I thought this was an interesting slide. Historically,
The top line, our hotel interest rate data is reported by the ACLI, the Insurance American Council of Life Insurers, compared to the 10-year T-bill yield. And I put the Fed target effective rate at the bottom just for interest purposes. But traditionally, the hotel interest rate spread has been about 200 basis points, give or take, over the last 5 years. And you can see if you look all the way to the right, that as of May 2018, there's a tremendous pop, if you will, in the difference between the hotel mortgage interest rate that was reported. That was just for the first quarter, mind you, and the 10-year T-bill. So you can see that already the capital markets had been responding to the risk in our industry and the downturn they were facing, and then the risk in our industry, and that spread has widened to 500 basis points. And I'm sure this will continue. And in fact, most lenders have withdrawn from the hotel market, and there's very little debt available for hotel transactions, which of course impacts value. We often look to what's going on in the capital markets, how lodging REITs are trading, what their trends are, and there are a couple of firms that actually calculate cap rates based upon the total enterprise value of the REIT relative to their earnings. And you can see the cap rate trends over the last 13 years. And the capital markets often portend what's headed into the future. And as of March 2020, you can see the cap rates had already started to rise. And that was before the impact of the COVID crisis. Once the crisis hit, this data started not becoming available, primarily because, as you can imagine, the earnings expectations for 2020 really was off the table. We are expecting that, as everyone knows, the REITs, like all hotels, many of them are actually going to have a lot of negative cash flow in their hotel properties. And so really calculating REITs was no longer as relevant, cap rates was as relevant. So I thought we'd look at maybe the REIT net asset value premium or discount. This is often calculated to say, well, what are the public markets? How are they viewing what the REIT stock prices are relative to the underlying asset values? And in prior years, back in 2012 and 13, 14, you could see that the stock market was paying a premium over the underlying net asset value of the underlying assets. And that started to dissipate when the public markets was paying more of a discount, if you will, to underlying net asset value. And you can see over to the right, as of April 30th, tremendous decline, something we've never seen before, due to the decline in stock prices of lodging REITs. And of course, underlying net asset value is really just a mathematical calculation. And the question is, well, what is that? But this is basically kind of pre-COVID to post-COVID expectations by the market. So again, a tremendous hit. We're looking back, we've started looking back at prior downturns, just like Vail and Jamie did, to see how things performed during those periods of time, to see how this may play out this time. This data from Real Capital Analytics is the average price per key. It means total volume, sales volume divided by the number of rooms sold. And this is how the market performed through the last Great Recession. The blue line being full service hotels, the red line limited service, and the gray line all hotels. And you can see that the full service hotels are typically more volatile during these periods of time because they have more operating costs to cover, and so their performance is much more volatile. You'll see a greater impact on their bottom line during a crisis like this. And so values decline more precipitously, and then they recover also very dramatically once the demand starts and the revenue starts to recover. And the issue with this kind of data is that it's very dependent on the kind of assets that sell at any given period of time. So this might actually lead you to believe that values recovered very quickly in 2011 from their nadir in the third quarter of 2009. And actually that wasn't the case. It's more about who was buying and what kind of assets they were buying. So in 2011, as you may all recall, the lodging REITs jumped into the market, tremendous pent-up capital to buy high quality assets. And so you saw a tremendous number of very high quality assets trading in that 2011 time period, which drove up that average price per key. And then we had a little bit of an economic financial fallout, if you all remember, and the REITs were impacted in 12 and 13. And then the number of the price of assets declined a bit, the average price, because those players pulled out for a bit. And then you can see 2015 was the peak of the market. A lot of people exited. Very high priced hotels were selling at that time, including a number of major portfolios. And you can see over to the right, as of 2019, the market was already starting to decline a bit. We already have seen some softening, and that has continued in 2020 in terms of the average price per key. Just repeating here, limited service hotels, similar metrics, just less volatile, easier to transact these assets, more capital available for them. But they too were high quality ones were snapped up in 2011, 12, and then they moderated again and have stayed fairly flat for the remainder of the cycle, and again downturning in 2020. So what RCA has come up with is a hedonic series, they call it, which is a different way of looking at the data, and it's trying to come up with not what the average price per key sold, which is based upon the types of hotels that sold, but more of, in a given year, what would the average hotel or any hotel in the United States would have sold for on average. It's just a kind of different way of looking at it. I don't understand the statistical basis for it. Definitions at the bottom if you want to look at it. You can see this smoothed out some of the jumps in the last data, and you can see in the last cycle from peak values to the next to full recovery was from 2007 to 2015, and that was about 8 years for values to fully recover. And from the trough to the peak or to the full value recover was about 5 years. So that's how long it takes when we get through these kind of crises. And you can see again on the upper right that already we had started to see value declines. So values were slipping over the last couple of years, even as the market still felt healthy. This is the RCA CPPI. It's a data that tracks resales of the same hotels, which is a really interesting metric. And of course, again, it only depends on the hotels that have actually sold, but it also shows a very prolonged recovery from 2007 and 8 as the peak back. Those values didn't become recovered until about 2017. So 10 years for some hotels in the United States, those that sold and resold, took about 10 years for them to get back to their prior values. We couldn't believe this when we first saw it, and then we started going through our sales database, and we found many sale after sale after sale where we were finding this to be true. We forget that hotels, they age out, they lose their franchises, and that the number of hotels in the United States is dominated by hotels in the mid-rate economy, upper mid-rate sector that go through these aging processes, and they basically, over their lifespan, do oftentimes decline in value, and they are impacting this data. So it's just interesting to see, interesting to note those trends. So clearly, if this is what's been going on in the past, it's also going to be challenging for us in this current environment. I'm realizing I'm running out of time here, so I'll go very quickly through the rest of this. Cap rates become elevated during times like this, as we've seen cap rates, because your net income that you're capping, all of a sudden you're seeing a reduction in net income, and so your cap rate based on trailing net income automatically rises. But the good news is that once people jump into the market, the cap rates start to decline. What we saw in the last cycle was, of course, this jump in cap rates, the decline in cap rates for all product types. But basically, compared to the last cycle, we had a much lower cost of capital. And what we oftentimes forget is that the tremendous appreciation of hotels during this most recent cycle was driven by this lower cost of capital that was sustained. And I guess the good news is that we should come out of this current downturn with similarly low cost of capital, but you don't have as much lower to go now because we're almost at the bottom. So what we recommend to people is that they use discount rates to value hotels right now, because cap rates are really irrelevant right now. They're going to be very high in trailing net income right now. They're going to be very low on current net income, because for many hotels, there isn't any net income, even if they're operating or whether they're closed. So you really need to do a discounted cash flow analysis. I'm going to just jump right to that. So we ran 3 different scenarios. We're not saying that these are the scenarios that are necessarily going to absolutely play out. They're going to be different for every product type. They're going to be different for every market that we see. We think the best case scenario here, which is about a decline of 20% in value, or for hotels that are going to be least impacted, tertiary markets, extended stay hotels, hotels are at the lower end of the price spectrum. And we think that By 23, 24, those values will have recovered. First, it's going to be occupancy, then ADR, then EBITDA. And through our modeling and assuming a slight elevation in 50 to 100 basis point elevation in discount rates and terminal cap rates, this is where our modeling points to when those prior 2019 values will be reached. For the most likely case, which actually are products that are in the middle of that kind of profile, we think it'll take an extra year and values will recover by 24, 25. And for the hotels that are the most challenged, the recovery will be by 25, 26. And these are based on actual models that we prepared. Now, indeed, this may not come to pass. This is our best estimate at this time. And it's important to remember to let, I always say, the air out of the balloon. You have to be sensitive in your valuation. Right, as people have said, there's really no evidence yet. We don't have the sales activity, but we are hearing about deals being retraded and what people are offering for hotels on the market. And we are hearing of pretty significant discounts to asking prices. And only until we start seeing the sales activity will we have the actual basis for supporting these projections that we're making. Just for context, again, the Real Capital Analytics Sedonic data concluded that the value of an average hotel in the U.S. declined by 27% in the last downturn. Upstairs, my timer there. So I just wanted to say this is when this chart shows you when the percentage change and the recovery over time. The years over here into best, most likely, and worst case when we're going to get back to 2019 values. That's our expectation at this time. And just this is a wrap-up slide. There's always good things and tough things. So right now, downwards pressure, unprecedented revenue and EBITDA decline, economic recession, deep ADR declines. And I think really ADR to me is the basis of this entire valuation exercise, because the extreme reduction in ADR that we're seeing is really the thing that may reprice hotels at a level that we may not even be able to envision right now. And we know how difficult it is to rebuild ADR. We know all the shadow supply that's out there that's going to make that challenging. So that to me is the key. We're already hearing of multiple areas where it's going to be tough to prevent continued ADR moderation over the next couple of years. To me, that's the major bottom line. Uncertainty regarding normalization of travel, potential for very prolonged recovery. And in the interim, this cash drain that these hotels, that people are telling me debt service is the least of my worries. I'm having to feed this hotel so much just to keep it open or closed. And they want to give the keys back to the lender, but the lender may not even want them. So want the keys because it's going to be such a cash drain. That's going to be a challenge. And that may force owners to sell. And that's when we might start to see some of where transaction and volumes are turning out. On the upside, there's improved business operating models. We're hearing of tremendous reductions in operating costs. People are down to skeleton crews. They're rebuilding from the bottom up, completely reinventing their operating models. And so what we're hearing is that there's going to be a much more positive operating leverage coming out of this downturn, which is going to be favorable, and people are going to try and hang on to that for the future. And then we have yield-hungry funds lining up capital to jump into the market, and they're going to create competition and help to sustain values, which is a positive. Low cost of capital is likely to continue, and lenders are going to want to wait for values to rise before losses are recognized. And so we don't think that on the lending side, they're not going to push things out onto the market, which oftentimes creates kind of a fire sale situation. So at the end of the day, we think there's lots of opportunities up for people to jump in. If you got capital, to jump in during this time period, and there are going to be incredible returns to be made once we end up getting a little clarity in the market and see where pricing actually is falling out. So that's my presentation. Thanks for your time.
Thank you, Suzanne. Thank you, Suzanne. I'm going to turn this over right away to Dan Lesser. Dan, we're running a little bit late here. If everybody is able to bear with us for a couple more minutes, Dan has some incredible information we're going to allow the time to go over if you're able. Dan, take it away.
Jim, thank you so much, and it's great to be here. Greetings from New York. I like Suzanne, got a little carried away, so my deck is fairly lengthy, but I'm from New York, so I speak fast, and I'm going to attempt to go through this as fast as possible. Jim, congratulations. I've been blessed to have been invited to do a number of these webinars, and this is the first one that I've done with over 1,000 attendees. So congratulations, and thank you for the invite. I think I believe my title slide kind of says it all. If I'm sure many of you on the line were around in the early 1990s when the phrase "stay alive till 95" was very prominent. So I decided to. I haven't heard anybody yet invoke it for 2025. So I think I may be the first one. But that's, and I think the prior presentation sort of proved that. Statistics, I'm not going to, I think we've covered that more than enough, and we know about the all-time revenue metric highs and profitability, and just, we were at all-time highs right before this happened. And, unfortunately, the virus has occurred. These statistics are as of this morning. It's really sad and very unfortunate, but it is unfortunately a reality of life. So, I've been sort of reminiscing on life, and one of my first memories in life is hearing my parents and watching black and white TV talk about the Cuban Missile Crisis when it was happening, and it was very much like, oh my God, the world's about to end, right? And if you think about it, the globe was quite different then. We didn't have technology and instant communication and news. So you watched the news and then you turned it off and you fretted all night. The Arab oil embargo in the early to mid 70s, again, it was like, oh my God, the world's about to end. 1987, stock market plunge. Oh my God, and it goes on, right? And so, the point is that yes, this is terrible. It's awful. We're all experiencing pain, but we're going to get through this, just like we have all these other prior events. I love this slide, and this comes from my friends at Robert Douglas. You can see that they're sourced in the lower right-hand corner. I know Steve O'Connor's on the line. I think this is a terrific slide. It really sort of tells you where we're at and where we're going. And obviously, you can digest the contents of this more when you download the presentation. Although we may not be formally by the definition in an economic recession, obviously we are. This has really been a very wide and deep impact. We've all heard about this. Unprecedented. More statistics. This is no different than what you've seen previously, and this just really is sort of more color coded to show. January and February in green, again, all-time highs, and then, just the fall off afterwards is absolutely astonishing. And then, if you look at the past 5 weeks, and this was updated this morning from the latest STR release, we can see that, Atlanta in the upper left-hand corner is on more of a rebound, if you will, than Oahu in the lower right-hand corner. This slide, Vale had this slide. The only reason I want to talk about this is that I think it's very, very, very important to remember, particularly for those that either are new to the lodging industry or only dabble in it. Right, the notion of a hotel's value moving dramatically, either up or down. And when I say dramatically, I'm talking about 20 to 50%, which is what we hear talking about. It's not unheard of, right? As illustrated by these metrics. And the fact remains that hotels are unique forms of commercial real estate, and they don't have credit tenancies. Every single night you're leasing up guest rooms, and the pricing of those rooms, with technology being what it is, changes by the nanosecond. In an up market, that's a beautiful thing. In a down market, it'll kill you. So we've seen a wide variety of interim uses. One of the first ones, Ty Warner offering up the Four Seasons for free stays, early on in this pandemic. Liquidity, all the big boys have shored up their liquidity, and it absolutely is key to being able to stay alive. Cash is 100% king, 1,000% king. And we've seen some unique maneuvers by Marriott and Hilton to raise cash right now. Clearly, the markets are braced for a significant rise in loan defaults and delinquencies. We're seeing that every single day, and it's going to continue. We're also seeing litigation. I mean, there's always litigation, right? Even in good times, you don't hear much about it, but there's a lot of it. But now we're seeing a tremendous amount of it, and it's only going to continue. The one I'm actually very interested in is the one on the upper left-hand corner, Anbang and Murray. I actually, until I came across this news, I thought that deal had closed. So that'll be an interesting one to watch. I know this has been, alluded to earlier by others who just, presented. There's a ton of dry capital out there, smart, sophisticated money that has already invested in the travel sector and is looking to invest further, and specifically hotels. The one I want to talk about that I find interesting is the London Ritz. That hotel is more than 100 years old, and the day that the transaction closed for the sale of that hotel was the first day in its history that the hotel's operations had closed. So I thought that was kind of interesting. The $1 million question, I know, Suzanne, talked about this, and I concur with all of her comments. You work with the best available data. At the end of the day, market value, there's a couple of definitions out there, but, willing buyer, willing seller, neither under duress. There's no seller out there today that is putting a hotel on the market unless they have to, right? So for the most part, if you have to transact and force some sort of price discovery today, you're probably more than likely looking at a liquidation value. And there's a whole, big difference between liquidation and market value. Clearly, with liquidation, you don't have the ability to leverage up lower cost debt as compared to equity. Real interesting. This is a PE firm that's focused on commercial real estate, not in the hotel sector, retail, and I believe industrial. Anyway, I came across this. I thought it was interesting. They put a note out to their investors, and these are a couple of two guys that actually have more than $50 million, or at least they claim they do, $50 million of their own personal net worth invested pari passu with their limiteds. And they wrote a letter basically saying to their investors on March 6th that they really had no idea what was going on, which I thought that was quite interesting. And again, I agree with what Suzanne said. You work with the best available data, but the market really has not spoken yet, and everybody is waiting for that. This is an interesting data point. If you go back to 2001, I actually remember working on this transaction, Blackstone acquiring Homestead Village. The deal was originally papered at $900 million in August of 2001. Ultimately, it closed in, I believe it was November or December, for a $160 million WACC, which works out to almost 20%. It's a data point, and I think it kind of fits in with some of the numbers that we've talked about, or we've heard about previously. Ethan Penner, he's recognized as the father of CMBS. I think it's very interesting that he recently came out with a proclamation, stating that it was great when he invented it back in the early to mid 1990s, but it was not built for 20 years later, and that it needs a significant overhaul. We probably didn't need him to tell us that. We all know that, but I just thought that was interesting. Where are we now? I'm not going to spend a whole lot of time. I mean, everybody can, again, download the presentation. Sponsors and managers are clearly in defensive positioning, bolstering liquidity. We talked about existing lenders are generally accommodating with 60 to 90-day interest accruing forbearance. I'm not so sure that does anybody a whole lot of good. The brands have offered up some significant relief. And then there's been a couple of debt modifications that are, the terms of which are in the public domain, that you can decipher on the right-hand side, just to get some sort of market intelligence as to what lenders are in fact doing out there. The road back, well, we can look to China, and thank goodness we have American hotel companies there, because we can trust. I think we can trust the data coming from them, and so they're seeing a lot of positive signs. hotels reopening. Americans are optimistic about travel. They always are, right? It's every American's God-given right to go on vacation, whether they can afford it or not. Unfortunately, as Yogi Berra once said, it ain't over till it's over. And as we all know, the cases are declining in many hotspots, many prior hotspots, but there are other locations where unfortunately it is growing. So this is far from over, is what we're being told. In many ways, we've seen this movie before, right? Everybody's talked about leisure coming back first, then corporate business, individual travelers, and group meeting is going to be a long ways off. And of course, international is going to take some time as well. We've seen this type of recovery in prior downturns. Some of the challenges out there, the airlines are in really tough shape, right? And think about how reliant the hotel industry is on the airline industry. And then we talked about, pressures on debt and the CMBS loan maturities. I mean, there's a tidal wave coming in. A couple of more challenges, getting people back to work. There was a period of time, I'm not sure if that still exists today, where you can make more money sitting at home than going back to work. I don't think if that still is available today, it's gonna last too much longer. It's interesting, like everybody else, I listen to webinars all day long while trying to do work. And I do find it kind of remarkable. I hear many, talk about hotels were always clean. I'm not sure that necessarily was true, as evidenced by these headlines, which are, back several years. This is an issue that I think is now solved, right? There's not going to be any question about adhering to certain guidance that has been available or been made available by not only the U.S. Travel Association, but also the American Hotel and Lodging Association, who convened an advisory council and came out with some high-level guidelines vis-a-vis enhanced industry-wide hotel cleaning standards. So I do want to point that out, but I also want to point out that, and I would like to actually say thank you, I hope on behalf of everybody who hopefully agrees on this call, to Chip Rogers and everybody at the AHLA, because I humbly believe that they have done yeoman's work representing the lodging sector in DC during these past couple of months. The cleanliness assurances, I do find it interesting. So the AHLA, got this group together and they came out with some guidelines, and then every brand has then gone out and formulated their own spin on branding cleanliness, which I'm not sure I really get that. I mean, I guess it's marketing. I kind of like that Hilton latched on to Lysol because everybody's heard of Lysol before, but I'm not sure this was necessarily necessary. I think everybody could have just gone along with the AHLA and continued to be on the same page of expanding what those guidelines look like, as opposed to promoting their own programs. Paradigm shifts that we're definitely going to see in the near term, whether they endure or not. Well, I guess this is not a travel paradigm shift, but the no shaking hands. I mean, I was a germaphobe before Donald Trump was a germaphobe, and I never liked shaking hands, and I never will shake anybody's hand again. So thank God that's over with. Flying is going to be very different going forward. Body temperatures are going to be taken all over the place. Paradigm shifts with hotel operations. We've heard all about this. Contactless, touchless. Hilton is going to have a seal on the door to get in to prove cleanliness and the like. We talked about the abundant availability of capital out there. I know that others have talked about that. It really is incredible how much cash is out there, and I believe Suzanne alluded to this. Listen, there's always a fair amount of opportunity on the market that is not necessarily very compelling. The ones that do come to market that have good stories and are desirable, there's so much money out there that I'm convinced that while they may be somewhat distressed, they're going to end up clearing pricing that is not necessarily distressed, because there's so much capital out there, and invariably what's going to happen is good opportunities are going to get bid up. That's my humble opinion. The future, I mean, clearly the world is being challenged, in addition to the pandemic, with lots of geopolitical stresses. We can, spend lots and lots of time talking about that. Hotels that were already over-levered or stressed from a cash flow perspective pre-COVID, they were at the cliff before. They're falling off the cliff or about to fall off the cliff now. There's a number of hotels in New York City that were at that point and most likely will never reopen as hotels. Brand proliferation hopefully will be placed on pause. At least I think it should, and hopefully for a long time. We have enough brands out there. We should be focused on other things. Some more future issues to be considering. I firmly believe the return of air travel and hotel stays is going to be in two waves, not one. It's first going to be occupancy and then rate. More about the future. The acceleration of incurable functional obsolescence is going to result in many hotels never reopening. We talked about that, and property tax appeals, ramp up. This is a great time to be renovating hotels, and a lot of folks are doing that. And in the near term, the brands are going to play nicely in the sandbox and be less onerous with PIP requirements. More near term, the one on the lower left, jingle mail. Again, if you were around in the early 90s, you probably remember that term. Well, it's back, right? And that's the sound that is placed when a sponsor puts the keys in an envelope and sends it back to the lender. We're starting to see it. We're going to see more of it. There's absolutely no doubt about that. Unfortunately, in the near term, and as evidenced by what's going on in China, right now, this is as of May 18th, over 100 million in China's northeast have been locked down again. I was actually shocked when I saw that. So listen, we know that what's happened over there may very well happen here, and we're hearing about secondary and possibly tertiary phases. It's a scary thought, but it's a reality, unfortunately, that may come to fruition. I'm going to pass over this one. Airbnb, everybody's sort of, at least from in our practice, we get asked all the time by clients and friends, what about Airbnb? So clearly they've taken a tremendous hit from a valuation perspective. Their cap is down 50%, and they've had to go out and raise 2 rounds of $1 billion each, and they've paid very dearly for that capital. I think it's a real paradigm shift for them, and this is moving the process of their evolution down the path of having the fat lady sing. I've always thought, and I'm thinking that now it may be even more possible, and this is based on nothing but my gut and doing what I've been doing for 40 years. But I can see at some point possibly a major hotel brand family merging up with Airbnb. So if it happens, you heard it here first. If it doesn't happen, forget I ever said it. Like anything in life, you can look at the glass half full or half empty. These are all recent headlines from just the past couple of weeks, right? Very smart, sophisticated, successful folks opining that they see some real trouble in the future, right? And then on the other hand, you can look at headlines that make the outlook look as if the glass is half full, right? Everything's relative in life. So I'm about to wrap up here. I came across this, and for me, I got a tremendous amount of inspiration, and hopefully everybody else will. So this gentleman, Tony Vaccaro, was born in Italy. His mother died at childbirth. He lost his father, and by age 5, he was an orphan. And he immigrated to the United States. He fought as an American GI in World War II, survived the Battle of Normandy. This gentleman, I Googled him, he went on to become a celebrated photographer. And at age 97, he survived a bout of COVID-19, and he attributes his longevity to blind luck, red wine, and determination. I thought that was fantastic. And then I came across this one, which is even more inspiration. And this 107-year-old woman survived the 1918 Spanish flu and then just survived COVID-19. So I'll finish up with this quote: "In all things, it is better to hope than to despair." And I'd like to thank Jim again for inviting me, and thank you for everybody for listening in, and appreciate your time.
Thank you, Dan. And thank you to all of our panelists today for a great presentation. As I mentioned earlier, if you go to hotellawyer.com, we will have the presentations up within the next 24 hours. You need to go to the resource center and then all the way to the bottom to the hotel industry area there. And we will also have a link to the recording of this session. So that's it for today. We plan to do a few more of these Meet the Money online sessions in the coming weeks. Look forward to seeing you. Be well, everyone.
Thank you.
Bye.